Hello class. Today we're going to talk about chapter 29, which is the monetary system. So in this class, what we're going to look at is what is money and what are the types of money that we have. We're going to study what the Federal Reserve is, and we're going to see how banks affect the money supply and how do they create money. And then finally, we're going to see how does the Federal Reserve control the money supply. So our first thing is what is money and why is it important? Well, without money, if money did not exist in this world, then the only way we could trade goods and services between each other is through bartering, which is basically the exchange of one good or service for another. In bartering, the problem is you need something called a double coincidence of wants, which is basically two people trading because each want the other person's goods or service. So supposing if I have a bundle of wheat or a bushel of wheat in my garage and I want to get, let's say, rice, I have to find somebody who has rice and who is willing to exchange their rice for my wheat. So such a problem does exist, and then it's easy to see like how hard it would be to trade because people would spend so much time searching for other goods that it would be, or services, that it would be a huge waste of resources. Now, this search is basically made unnecessary if money is present. Then, if I really want rice, I could pay that the person with rice some money so that I could then exchange it for some rice. And then that person who just sold me the rice can use the money to buy other things that they need. So money totally eliminates the require for double coincidence of wants. Now there are three functions of money that we know. One is the medium of exchange. It's basically the use of money to buy goods and services. So within the US dollar is used as a medium of exchange. We use it to buy goods and services. It's a unit of account. We use that to measure the value of products. So if I say something costs $5 and something else costs $100, I know that the product that costs $100 is more expensive than the one that's costing $5. So it helps us to measure the value of products. It's also a store of value. Money can be stored and can be used at a future date. So basically, it doesn't lose its value, or it loses some of its value because of inflation, but it doesn't become completely worthless, let's say. You can actually save it and use it later in the future. There are two kinds of money that we know. Commodity money is one of them, which actually has intrinsic value. So basically, if you break it apart and then put it back together, it still has value. So some examples are gold coins. Cigarettes in prisoner of war camps is also considered to be commodity money. In different prisoners of war camps, sometimes prisoners are supplied with certain basic rations like cigarettes. And so people, or the prisoners there, found out that instead of smoking the cigarettes, they could actually use it as money because it satisfied some of those conditions that money needs to satisfy. However, nowadays we use money that is called fiat money. Fiat money is money that has no intrinsic value. So basically, it has value because the government said it has value. So the US dollar is fiat money. The US dollar is one of the most unique currencies in the world because all the dimensions of $1, $20, $100, they're all the same. So basically $1 has the value of a dollar because a dollar, it got stamped by the print that says $1. The $100 has a value of $100 because it got stamped by the thing that says it has $100. But in reality, I mean, if you shred the dollar and you put it back together, I mean, it doesn't have the value anymore. So fiat money is intrinsic. It's the actual intrinsic value of a dollar is the paper or the cotton that is used to make it, but other than that, it doesn't have any value like a gold coin. So the money supply that we will talk about is the total amount of money available in the economy. How much money is being circulated in the economy. So what assets should be considered part of the money supply? There are two candidates. Well, one is currency, so the actual paper bills and coins that we have in the hands of people. A lot of us carry cash or coins with us all the time. So that's part of money supply. The other kind is demand deposits, the kind of money that we put in our bank accounts. We don't carry all the money that we have in our pockets. It's actually not safe to do that. So part of our money that we actually get from working or from our businesses, we save it at the bank in our bank accounts. So those accounts can be accessed using writing a check or using our debit card. So that's the other kind of money that we have. There are two measures of money supply that we have. One is called M1. M1 includes currencies, demand deposits, traveler's checks, or other checkable deposits. M1 is the measure of those currencies or that part of money supply that is as close to cash as possible. So currency is as close to cash as you can get. Demand deposit is basically checkable deposit. So yeah, I mean, it's right there. It's not with you physically, but you could easily access with a check. Traveler's checks are also part of money supply and other small different kinds of checkable deposits that we have. So according to September of 2013, and the number is still pretty similar today, M1 is about $2.6 trillion. So $2.6 trillion worth of notes and coins are circulating, either in the economy or they're in our checking accounts. The other measure is M2, which is everything in M1, so M1 plus money in your savings account. So, and some small time deposits, which are also different instruments of savings account, money in your money market mutual funds, and a few more minor categories. So these are slightly away from cash. You can't write a check using your savings account. So how do you do that? You transfer your money from your savings to your checking account, and then you write a check. So M2 includes all the things in M1, plus certain things that are slightly harder to get. So M2 in some measure, and it's also pretty similar today, it's about $10.8 trillion. So in this course, we're not going to make the distinction between M1 and M2 when we talk about money supply. So when we talk about money supply, we could either talk, let's say it's M1 or M2. In upper level courses, we have to make that distinction. Now, the organization that controls the money supply is known as central bank. And the instrument that they use to control money supply is called monetary policy. So it is the way central banks use to basically increase or decrease the money supply. The amount of money that is circulating, as we will see later in the next chapter, it does affect the economy. And so we want to see how that can happen. Federal Reserve is the organization. It's the central bank of the US that controls the supply of US dollars. The Federal Reserve System is actually, it was created by the US government, but it is independent of the US government. So it can actually implement its policies without consulting the president or the Senate or the Congress. So what is the Fed? The Fed consists of Board of Governors, 7 members, which is located in DC, 12 regional Fed banks located all around the US. And they use something called the Federal Open Market Committee, which is basically which decides the monetary policy of the US. Now, the current chief of the Fed is this person. Her name is Janet Yellen. In some accounts, she is the most powerful person in the world. She has a lot of clout. Basically, she controls how much dollars there are circulating in the US economy. And she is actually appointed. She's not elected. So there's a Senate hearing committee that appoints her to become the chairwoman of the Fed. And she's not accountable to anyone, so she can set any policy that she wants, and basically whatever the policy she sets affects the interest rates that we pay on anything that you can think of. Your student loan, your car loans, your house loans, mortgage loans, everything, that any kind of things that has a dollar sign in front of it is affected by the policies taken by Janet Yellen. So bank reserves. In a fractional reserve banking system, banks keep a fraction of their deposits as reserves and use the rest to make loans. So when we deposit our money in banks, banks keep part of our money as deposits, and the rest of it they give it out as loans. And loans are the way that banks can earn money because when we take out a loan from a bank, excuse me, we have to pay the bank, well, the principal and some interest along with it. That interest is known as, well, the income of the bank. The Fed establishes this reserve requirement. So the Fed tells the banks that what is the minimum amount that you have to keep within your vaults and how much can you give out as loans. So if a bank has 100 per, let's say gets $100 as deposits, if the Fed says that the banks have to keep 20% of their deposits as reserves, then the banks must keep $20 within their vaults and the rest $80 they can give out as loans. Banks can of course hold more than the minimum amount if they want to, but the Fed basically sets the guideline for the minimum amount that the banks must hold. The reserve ratio, R, is basically the fraction of the deposits that the banks hold as reserves. So how much money the banks have to keep as a percentage of the total deposit that they get. Or it is the total reserves as the percentage of total deposits. So if they get $100 as deposits and they keep $20 as reserve, then their reserve ratio, or R, is 20%. So let's look at a T account. A T account is basically an accounting method that shows the assets and liabilities carried by a bank. So let's look at this example. Let's say the First National Bank operates in Elon and I go and deposit $100. Now what happens is the bank keeps a certain amount as reserves as mandated by the Fed and gives out the rest as loans. So $100 out of $100, $10 is kept as reserve and the rest $90 is given out as loans. Now in this case, the bank's liabilities is the deposit I gave the bank. Why? Because that deposit is my money. And so when I'm giving it to the banks, I'm telling them to make sure my money is safe. That's the only reason why I put money in. That includes loans and reserves. Now, so when I'm depositing, why is the deposit considered to be a liability for a bank? Because when I deposit my money in a bank, I expect the money to be safe in the bank. So the bank has a responsibility to keep my money safe. So it's a liability for the banks. The liability is to keep my money safe. And how it is using the money for income purposes, that's the asset. So it is keeping some money as cash, and that's the reserve. So that's part of their asset. And it is giving out $90 as loans, which is used basically to earn income. And so assets must equal liabilities in this case, and so that's why we have this setup. In this example, if you notice, the reserve ratio is the percentage of deposits kept as reserve, which is 10 divided by 100 times 100. So 10% of our money is deposit is kept as reserves. Now suppose we have $100 of currency in circulation. Now if we want to see the bank's impact in money supply, we want to calculate the money supply in 3 different cases. So one is, what if there is no banking system? What happens to money supply? Number two is, what if the bank has a 100% reserve banking system? So basically the banks just hold the deposit as reserve, but they're not allowed to make any loans. And the third kind is fractional reserve banking system, where the banks are allowed to keep certain amount as reserve and give out the rest as loans. So in the first case, no banking system, what do we have? Let's say the public holds $100 as currency. And that's it. So basically, even if how much they spend around or what they do with it, the money supply is always $100. So the money supply doesn't change. If there's a 100% reserve banking system, well, the public first deposits the money at First National Bank, let's say. The First National Bank holds all the money as reserve. They're not allowed to make any loans. So in this case, money supply remains $100. So in a 100% reserve banking system, the banks do not affect the money supply. The money supply remains the same. Now in the third case, the fractional reserve banking system, supposing we have R of 10%, that is, the banks have to keep 10% of their deposit as reserves, and they can give out 90% of their deposits out as loans. So in this case, when I first deposit my money in the bank, the reserves go up straight up by $100 because the bank cannot give out all the money as loans that they can that day. Probably in a week or so, they can give out all the money as loans. So if reserve ratio is 10%, they keep $10 within their bank and give out $90 as loans. So supposing I deposit $100 and the bank makes a loan to Ted for $90. So now Ted has $90 of money because Ted just got $90, but I believe that I have $100 in the bank because that's my money, and so and if I go the next day to withdraw it, I should be able to withdraw it. So I believe that I have $100. Ted, who took the loan, believes he has $90. So depositors have $100 in deposit. The borrower, which is Ted, has $90 in currency. So the total money supply right now is $190. So it just went up by $90. Even though the amount of cash there is only $100, the total money supply in circulation is $190. So how did the money supply grow suddenly? So when banks make loans, they create money. Well, the borrower gets currency, but which is basically debt, because the borrower has to pay back the money at a future date to the bank with some interest. So a fractional reserve banking system creates money, but it doesn't really create wealth, although we think money is wealth in some cases. But in this case, when the bank is issuing debt, it's not really creating wealth. The debt can be used later to create wealth if the money is used or invested in the right way. But at least for now, it is just creating debt. But money supply is definitely going up because my deposit is still the same, but the borrower is getting loan, which is basically currency. Now it doesn't end here. Supposing Ted, who's the borrower, takes the $90 and deposits it at Second National Bank. So initially, once it deposits $90 in Second National Bank, the reserve goes up by $90 right away. And then let's say the Second National Bank's reserve ratio is also 10%. So within a few days, they will keep $9 in, which is 10% of 90, and loan out $81 to someone else. So let's say Pam. So Pam gets $81. Now, if Pam takes that $81 and puts it in a Third National Bank, let's say, initially the reserve ratio goes up, or the reserve goes up by $81, but then only 10% is required to keep in the bank vault. So $8.10 are kept within the bank, and $72.90 is loaned out to, let's say, Bill. And so this keeps on going. This process keeps on growing. So every time a new loan is made, money is created by the banks. And so if you keep on going and keep on adding every time a loan is made, the total money supply grows to about $1,000. The only notes and coins that isn't present is my $100. That's the amount of notes and coins, but the total money that we feel like is floating around in the economy is $1,000. So in this example, $100 of reserve of notes and currency generated about $1,000 of money. Now, why do we know this? How did that happen? We know it because of this number called the money multiplier. It is the amount that the banking system generates for each dollar that we deposit in our banks. So the money supply is actually equal to 1 over R being the reserve ratio. So in our example, R is 10%. So the money multiplier is 1 over R, which is 10. Let's say if the R, let's say if R was 20%, so the banks were required to keep 20% of their deposit as reserve, then the money multiplier would be 1 over 20%, which would be 5. So now if I deposited $100, that $100 would grow to $500 in the course of time. So my $100 of deposit would create $500 worth of money supply. In this case, if R is 10%, then $100 of reserve creates $1,000 of money. So let's say in this case, if you're cleaning your apartment and you find under the cushion, you find a $50 bill, and you deposit that in your checking account. The Fed's reserve requirement is 20% of deposit. What is the maximum amount that the money supply could increase? What is the minimum amount that the money supply could increase? So what is the maximum amount? Well, the reserve ratio is 1 over R, which is 5. So the maximum possible increase is 5 times 50, which is $250. But money supply also includes currency, which falls by $50. So the maximum increase in money supply is $200. So basically, since eventually if I deposit $50, it will grow to $250. But part of this $250 includes this $50 of initial deposit. So the maximum increase of money supply is 250 minus 50, which is $200. So if your bank basically makes no loans on your deposit, just keeps all of it, then basically it's just holding $50. Deposits increase by $50, but the money supply does not change. Now here's a more realistic balance sheet. Besides reserves and loans, banks also hold securities, which is basically government-backed bonds. So sometimes government needs money from us because they have to finance a lot of different kind of investment activities. So they issue IOUs, which is a bond. So basically they give you a sheet of paper and they're saying, all right, here's $100, please give me $100, and in a few years I'm going to pay you back with $100 plus some interest. So besides deposits, banks also get funds by issuing shares to the public or by issuing debt. So banks also borrow from other banks if they want to expand. So bank capital is the resources a bank obtains by issuing equity to its owners. So how much shares it sells to its owners, or how much did the owner invest in the bank? It is also bank asset minus bank liabilities. Leverage is a concept that how much of the borrowed funds is the bank using for investment? So here's a more realistic approach. So let's say the bank gets $800 as deposits. The bank owner invested $50 in the bank, and the bank issued $150 worth of debt. So what happens is, let's say you have a lot of smaller banks in many small towns and cities of the US, and they may not have enough investment opportunities within their area. So what they do is that they get all the deposits, but they can't make out. They can't give out any loans. So those smaller banks give money to bigger banks in bigger cities. So the bigger banks borrow money from the smaller banks, and then they use that money to give out as loans. And in return, the smaller banks get some money as income. So they get their debt back, and they get their loan back from the bigger banks and some interest. So the leverage ratio here is the ratio of assets to bank capital. So asset is how is the bank using the liabilities. So the bank keeps $200 as deposits or as reserves, gives out $700 as loans and bought $100 of government-backed debt. So in this case, the leverage ratio is, well, if we add all the assets, we get $1,000. Total capital is 50, so the leverage ratio is 20. Now, what does this number mean? So this number means that for every $20 in assets that the bank has, $1 is from the owner, and $19 is from someone else, is borrowed funds. So for every $20 that they have, $19 is someone else's money. So leverage can be important when it comes to measuring profits and losses. So in this case, supposing the bank made some great investment and their assets go up by $50, by 5% from 1,000 to 1,050. So this basically, if the bank owner is keeping all the money, then the bank capital goes up by $50, from $50 to $100. So it doubles owner's equity. If instead, if the assets fall by $50, 5%, so supposing bank capital, the bank made some bad investments, the bank can't come to the depositors and say that, you know what, I made some bad investments, so I'm gonna deduct some money from your checking account. The depositors will be pissed off. So the bank basically has to absorb, the owner has to absorb the losses. So if that happens, supposing the bank made some bad decisions and the assets fell by 5%, basically there are some loan defaults and stuff, then bank capital will fall because the bank has to pay money out of its pocket to replenish the deposits that they use to make loans. So the bank capital falls from $50 to $0. So we can see this, in this case, if the bank assets fall by more than 5%, then the bank capital is negative and the bank becomes insolvent. So capital requirement is a government regulation that specifies a minimum amount of capital that the banks must keep. So how much leverage ratio must banks have? And it is a requirement that the Federal Reserve also institutes, that this is how much you should keep. So why is this important? So during the financial crisis, the banks suffered a lot of losses because of the loans they made. They made some loans that were not supposed to be financially sound. A lot of people got money from their loans. A lot of people got money to buy houses, but they could not pay it back. And so it led to widespread defaults. So many banks became insolvent, and during the period of 2008 and 9, 166 banks became insolvent. So many banks found themselves with very little capital. So they didn't have much bank capital because they had to pay off some of those losses from their own bank capital. And so banks responded by reducing lending, and this led to the credit crunch. You may have heard that term before, credit crunch, but it basically made banks wary of giving out loans, and so they stopped giving out loans. So to ease the credit crunch, what the Federal Reserve did and the US Treasury is they bought a lot of shares of banks, so basically increasing the level of bank capital. So they bought hundreds of billions of dollars worth of shares. This made the US taxpayers part owners of many banks in the US. This policy actually helped to recapitalize the banking system, and they helped to restore lending to normal levels back in by 2009. Now the Fed controls the money supply. As we learned, money supply equals money multiplier times bank reserves. The Fed can actually change the money supply by either changing the bank reserve, as we can see, or by changing the money multiplier. So if we change either this part, the bank reserve, if we increase more money supply or increase more currency, this can go up, or it can actually change the reserve requirement ratio that changes money supply. So how does the Fed influence reserve? The Fed does it through something called the open market operation, which is the purchase and sell of US government bonds. So if the Fed buys bonds, so let's say this is the Fed basically is a money printing machine. So this is the Fed, and this is the bank, let's say. So if the Fed buys bonds, so if the Fed is buying a bond, pay the bond with money. So the Fed prints US dollars and gives it to the bank. So when the money then goes to the bank keeps a certain amount as reserves and can give out the rest as loans. So that increases money supply. So the bank, with more reserves, the bank can make more loans and increasing money supply. If you want to decrease bank reserves, so now if we have the Fed here and the bank, if the Fed thinks that the banks have too much money, the Fed says, all right, well, I am selling you government bonds. So Fed is selling the government bonds. And in return, will the banks have to buy it using dollars? So the banks have to spend dollars to buy the government bonds. So the banks transfer money from their reserve to the Fed. And the Fed just keeps that money. Now the banks now hold bonds, which they cannot use to give out as loans. So that reduces money supply. So the Fed can also make loans to banks. So because the Fed controls money supply, Fed can just, if the banks need money, the Fed can give loans to banks. The traditional method has been discount rate. Basically, the Fed just, the banks ask for money and the Fed fixes an interest rate and then gives the money to the banks at that interest rate. The new method is term option facility, where basically the Fed chooses that, all right, I want to lend out $2 billion. Then the banks bid on that money, how much interest they're going to pay. So probably, let's say Bank of America says 1%, Wells Fargo says 1.5%, and so on. And then finally, the person or the bank that's the highest bidder gets the loan. The more the banks borrow, the more reserves they have for funding new loans, and that helps to increase money supply. So we also have reserve ratio, which is the proportion that banks have to keep within their reserves. The Fed sets this requirement, and the Fed can change it. If it increases the reserve ratio, as we saw earlier, it can reduce money supply. If it reduces reserve requirements, it lowers the reserve ratio, and that can increase the money supply. So since 2008, the Fed has actually paid interest on the amount that the banks keep as reserves with the Fed. So if there's 20% reserve ratio or reserve requirements, so out of $100, $20 must be kept within the bank vaults. Since 2008, the Federal Reserve has been paying interest on that $20 to the banks. So the banks have an interest or have an incentive now to keep money in reserves. Before, they paid zero interest. The Fed paid zero interest on that reserve. Now the banks get some money out of it. So if the Federal Reserve raised that interest rate, it would increase the reserve ratio automatically, and that would lower the money multiplier. So if it wanted to raise or lower money supply, it would just raise the interest it pays on the reserves. Bank runs are something that happened before. Nowadays, it doesn't happen as much. When people suspect that their banks are in trouble, people want to go and withdraw their funds. Under fractional reserve system, banks, as we saw, because my $100 initially, as you saw that, my $100 of deposit created $1,000 of money supply. Now, if we all suspect that the banks are going to fail, then if we all go to withdraw our money, the bank does not have enough money to pay us all back. And in that case, the bank has to close. And so if there is a risk of that, banks may not even make as much loans because it's kind of risky to do that. So all these events increase the reserve ratio, and it causes money supply to fall, because if everyone wants to withdraw their money from the bank, that money multiplier thing doesn't work anymore. So, and if that's the case, then the bank wants to hold more money as reserve, and that even reduces money supply even further. And so that causes money supply to fall. So during the Great Depression, there was a wave of bank runs because people were not very satisfied that their money will be safe in the bank. And it caused a lot of bank closings and it caused money supply to fall by almost 28%. Many economists believe that this is one of the reasons, not the main reason, but one of the reasons that caused the Great Depression to be so severe. Since then, to prevent this, the federal government has issued or has given an insurance program or instituted an insurance program called FDIC, Federal Deposit Insurance Corporation, which is, if you look at your bank, it will say it is a member of FDIC. So which means that if you lose your money because the bank fails, you will get a certain amount, up to $100,000 back. So if you deposited $2,000 in your account, you would get $2,000 back. If you deposited $250,000, you will only get up to $100,000 back. The last bank run that we saw was the Northern Rock Bank in the UK had one in 2007, and it was eventually taken over by the British government. So the federal funds rate, this is a final thing we have. On a given day, what happens is banks may not have enough money, may have to give out, supposing a bank, suddenly a lot of people came to withdraw their deposits from the bank, and they may not have enough money to satisfy them. So what banks do is that they may borrow money from each other. So banks with excess reserve, banks who have more money than they are giving out as loans, might lend money to another bank who may need money right now. And then within the next 2-3 days, the borrowing bank might pay back the loan to the lending bank. The interest rate that the banks charge each other is called the federal funds rate. Now, the Federal Open Market Committee uses the open market operation that we talked about, buying and selling of bonds, to fix this federal funds rate. So basically, if there's too much money supply, interest rates will go down. If there's too little money supply, interest rates will go up. And so the federal funds rate has a huge effect on all the other rates in the interest in the economy. So the federal funds rate is the base. Every other interest rate that we can know and think about is affected by the federal funds rate. So if federal funds rate goes up, all the interest rates across the board will go up. So this is how it is. If we look at the red one is federal funds rate. Okay, so as it moves exactly with 3-month T-bill, which is a government treasury bill. So this is a bond, a type of bond issued by the government. That's the mortgage rate. As you can see, it completely follows the federal funds rate, and so does the prime interest rate. Prime interest rate is the amount you give to the best borrowers.